National University Sudan, Faculty of Administrative Science. Assalamu alaikum and welcome everyone. I'm Dr. Magda Mustafa. In today's lecture, we will discuss the production cost with a special emphasis on short-run cost. Understanding production cost is essential because every business, whether large or small, must control cost in order to maximize profits and remain competitive. By the end of this lecture, you should be able to distinguish between different types of production cost, explain explicit and implicit cost, understand opportunity cost and sunk cost, calculate short-run cost measures, including fixed cost, variable cost, total cost, average cost, and marginal cost. Interpret cost tables and understand how costs behave as output changes. Let us begin. The nature of cost. Production cost represents all the resources used in producing goods and services. Economists are interested in the economic cost of production rather than only accounting expenses. Why is this important? Because managers constantly make decisions such as, should we produce more? Should we hire another worker? Should we purchase a new machine? Should we continue producing a product? Good decisions require understanding all relevant costs. Economists therefore classify cost into different categories. Explicit cost. Explicit costs are actual cash payments made by a business. Examples include employee wage, rent, electricity bills, raw materials, transportation cost. These are recorded in accounting statements. Now consider implicit cost. Implicit costs do not involve cash payments. Instead, they represent the value of opportunities that the business owner sacrifices. For example, suppose you own a building and use it for your business. Although you pay no rent, you give up the rental income you could have earned by leasing it to someone else. That foregone income is an implicit cost. Similarly, if an entrepreneur works full-time in their own company, they sacrifice the salary they could have earned working elsewhere. That salary becomes an implicit cost. Remember, economic cost equals explicit cost plus implicit cost. A manager has two options or choices. The first option is attending a free training class. The second option is attending a lecture by Warren Buffett. The Buffett lecture cost $40, but the manager values the lecture at $100. If the manager chooses the free class, the benefit given up equals 100 minus 40 equals $60. Therefore, the opportunity cost of attending the free class is $60. Notice that opportunity cost is not simply the ticket price. It is the value of the best alternative foregone. Cost of durable goods. Some resources last for many years. Examples include machinery, buildings, computers, vehicles. These are called durable goods. Since these assets are used over several years, their cost is spread across many production periods. This process is called depreciation. Instead of charging the entire cost in 1 year, businesses allocate the cost gradually. This gives a more accurate measure of production cost. Short-run cost. Now we move to one of the most important topics. In the short run, at least one factor of production is fixed. Usually this is the factory size or machinery. Other inputs such as labor and raw materials can change. This leads to two major cost categories. First, fixed cost or FC. These costs remain constant regardless of output. Even if production is zero, the business still pays these costs. Examples include rent, insurance, salaries of permanent managers, property taxes. Second, variable cost or VC. These costs change with production. The more units produced, the higher the variable cost. Examples include raw materials, hourly labor, fuel, packaging. Finally, total cost. Total cost equals fixed cost plus a variable cost. This relationship is very important. Please remember the formula. TC equal FC plus a VC. So now let us examine this table. Notice that the fixed cost remains $500 at every output level, 0, 10, 20, 30, 40. It remains $500. It never changes. Variable cost starts at 0 when the output is 0 and increases as production rises. As a result, total cost also increases. This table clearly illustrates the difference between fixed and variable cost. Students should always check which costs remain constant, which costs change with the level of output. That distinction is the key to understanding short-run production cost. This graph explains the variable cost and the fixed cost and the total cost. The blue line represents the fixed cost since it remains at $500 at all levels of output, while the orange line represents the variable cost and it increases with the level of output. When the level of output increases, the variable cost increases. The green line represents the total cost. Observe that it starts from 500. Why? Because total cost equals fixed cost plus variable cost. Let us come to managerial cost. Managerial cost is one of the most frequently used concepts in economics. It tells us how much extra cost is incurred when producing one additional unit. Mathematically, marginal cost equals the change in total cost divided by the change in output. Suppose total cost increases from $2,000 to $2,020 after producing one extra unit. The additional cost is $20. Therefore, marginal cost equals $20. Managers use marginal cost when deciding whether producing one more unit will increase profits. Look here to marginal cost. Marginal cost is equal to delta T total cost divided by delta Q, mean that the rate of change in total cost divided by the rate of change in output. It's also equal to delta variable cost divided by delta Q. For example, this example, if the total cost increases from 2000 to 2020, that means the rate of change is $20, while the rate of change in the quantities of output produced is only 1 unit. So marginal cost equal $20 per additional unit. Average fixed cost. Average fixed cost is simply fixed cost divided by output. As production increases, fixed costs are spread across more units. Therefore, average fixed cost always falls as output rises. For example, if fixed cost equals $500 and output equals 50 units, average fixed cost will be 500 units, $500 divided by 50 units, so it is equal to $10 per unit. This explains why large firms often benefit from producing more units. Average variable cost. Average variable cost measures the variable cost per unit produced. So variable cost divided by quantity. This is the formula that appears here. So if variable cost equals $900 and output equals 50 units, average variable cost equals $900 divided by 50 equal $18 per unit. Managers compare average variable cost with selling price to evaluate production decisions. Average cost or average total cost is also called average total cost. It tells us the total cost of producing one unit. The formula is average cost equal total cost divided by quantity of output produced. So it can also be calculated as average fixed cost plus average variable cost. In our example, total cost equals $1,400, output equals 50 units, so average cost therefore equals 1,400 divided by 50 equal $28 per unit. So average cost is widely used in pricing decisions. Let us come to the summary table. This table combines all short-run cost measures. Notice several important buttons. First, fixed cost remains constant at all levels of output. Second, variable cost increases as output increases. Third, average fixed cost decreases as continuously as output increases. Fourth, average cost generally decreases at the first and later may increase because of diminishing returns. Finally, marginal cost reflects the additional cost of producing one more unit. Understanding these relationships is essential because they explain how firms determine efficient production levels. Let us summarize today's lecture. Today we learned the difference between explicit and implicit cost, the meaning of opportunity cost and sunk cost, the characteristics of fixed and variable cost, how total cost is calculated, how to calculate average cost and marginal cost, how production costs change in the short run. These concepts form the foundation for our next topic, where we will study cost curves and determine the firm's optimal level of production. Thank you very much for your attention. Please review today's examples carefully and practice calculating the different cost measures from production data. I look forward to seeing you in our next lecture. Thank you and goodbye.